I'm Deborah Borchardt, and this is your midday market update. When we look at the indices, we're seeing a bit of selling across all three of them. We did get some earnings out today, Deere and Macy's. Both of them, while they made their analyst expectations, they really disappointed on the sales. Sales were down for both of these companies, and we're also seeing something else in the market, and that has to do with the treasuries. And joining me now is Mark Newton. He's the chief technician over at Greywolf. So Mark, what are you seeing in the treasuries, and how is that going to correlate to the stocks?
Well, interestingly enough, I mean, the data that came in this morning on inflation was pretty dour, but we saw Treasury Yields, at least on the 10-year, break down to new 6-month lows. So that's interesting and important, typically because you have seen equities correlate quite positively to Treasury Yields. Both have been moving in unison really since the beginning of the year. So now Treasuries are below the important May lows at 257. Likely we'll see a move down to 245 in my opinion. So to the extent that equities follow, we'll see. I mean, the S&P and the Dow recently hit new highs. That's certainly a positive. NASDAQ's been lacking, struggling to try to find a bottom, I think, in financials and in technology. It's been tough to come by. We are seeing some good strength in emerging markets, and that's something to point out, though. That's very encouraging, I think, along with the move back into growth from value. And so those are two things that are constructive. I think that if we were to get any type of seasonal correction right now, it would prove minor. We are in a time in May which historically has proven to be bearish for stocks, at least over this next couple weeks. But the patterns continue to look pretty constructive, and we haven't really seen the S&P and Dow join the NASDAQ at moving to new lows along with the Russell.
Right, and you know, and that's what seems to have befuddled so many traders and investors, is that you get things like Macy's saying things are not as strong as they wanted, Deere saying things are definitely not going to be that great for the rest of the year, and yet the market continues pushing higher. It almost defies the weak guidance.
There's a lot of bearish factors, both technical and non-technical. I mean, if you look at the revenue deceleration we've seen over the last couple quarters, it's definitely a concern. Yes, they've taken earnings expectations down. Companies seem to be beating earnings, but yet the revenue shortfall is a problem. We still have geopolitical concerns. That's a big deal. Technically speaking, on this move to new highs in the S&P, we only got 10% of S&P hitting new highs. We only have 140 NYSE issues right now at new highs. That's about a third of what it was last May. All of those are problems, but we haven't really seen the breakdown. And indices continue to remain afloat. This whole gloom and doom scenario, though, is creating sort of a wall of worry, I would argue, which means that large caps don't have to move right down and meet this move in small caps right away. If anything, it probably means it's going to be delayed yet again, and it's postponed probably until June or July.
All right, well, there you go. As Mark's saying, there are a lot of negative headwinds, and we could see that eventually hit the Dow and the S&P. We're just not seeing it yet. That's Mark Newton from Greywolf, and I'm Deborah Borchardt with The Street.